Hello and welcome to The Appointment. My guest is someone whom India Inc. and the investor community is very keen to hear, because he comes actually as an outsider to the public sector banking world, the world that is now under scrutiny. I have with me the Managing Director and CEO of Bank of Baroda, Mr. Jayakumar. Mr. Jayakumar, thank you very much for joining.
Thank you very much for calling me over.
Well, first up, Mr. Jayakumar, while I want your comments as an outsider to the public sector banking world itself, the more immediate event is your results, and it was both shock and awe as well as a pleasant surprise. First up, if you can once again break up for us the rise in slippages and the rise in GNPA. How much of it was because of the Reserve Bank's asset quality review? How much of it was from restructured book? Just the nitty-gritties.
Yeah, sure. I think as a manus, we had a 15,800 crores of deterioration. About 7,100 crores of them came from the AQR policy of the RBI. About 1,000 crores came from restructured assets. We spent a little bit of time looking hard at our numbers, customer level, especially small tickets, to make sure NPA numbers are reported as NPA. So there was some catch-up on that. That accounted for about 3,200 crores. The balance is the normal flow that happened from customers who have been 60 to 90 days overdue. So if you ask me, the core flow was about 3,300 crores or thereabouts. One of them was a one-timer, and the rest of it was by AQR. But surely these would have come back as loss at some point of time to us. It's just a point of time when these customers who are not paying with other institutions would stop paying to us. So the losses have just been brought earlier, but they were embedded in the balance sheet. For us also, it is the AQR has been a useful exercise, because it has given us information about customers who are at a higher risk, and we've been able to address them by cleaning the balance sheet. So that's really what it is.
Okay, first let me get a pleasant question in and then go back to the asset quality. When you say that even some of the 60 to 90 days, which are not technically NPL, have been recognized, should we therefore assume that the chances of pulling up some of these which are already NPLs to upgrade them to standard is there? I mean,
so let me just first clarify. What I said was that the 60 to 90 day, what is called as SMA2 exists. On a statistical basis, these accounts pay us the last week of the month, and it's been going on, and our managers are very confident that they will keep it there, and some of them they'll be able to rework. But when you actually go to the real NPA story, a large number of customers are real assets. These are power plants, these are roads that are completed, a variety of these assets. So, and we all know creating this asset in this country or anywhere else is a fairly tough task. Currencies have also depreciated from the point these assets were first invested. So yes, they may be marked down. In some cases, there will be marked down. But on the balance, I feel the provision that we have got is adequate to deal with the potential deterioration in those accounts. So as far as the callback is concerned, it's going to happen. As I said, because these are productive assets, the cash flows will start moving along, and at least for bulk of them, and so you would see recoveries. The question is, if the economic recovery is faster, then the bounce back would be quicker. If the economic recovery is slower, then the bounce back might be slower. The things we were concerned about was iron and steel, because it was EBITDA negative. So, and that is now probably got addressed by the recent duties that have been levied on new imports. So on the balance, I think the largest exposure that is probably not addressed, though we have very few of them, is probably the gas plants in coastal Andhra Pradesh, located in coastal Andhra Pradesh. So those would, in my view, they are valuable assets. The government has started supplying some power to keep these machineries humming, and I think it's a point of time when the fuel will flow, and then those would also come back. So I think there would be recovery, but in some instances, we'd have to take a write down.
Okay, write down
of the value of the loan.
How much of the remaining assets? What is your exposure sectorally to steel and gas-based power?
Gas-based power is practically inconsequential. Whatever is there, they've been provided probably to 80% of the value. Even otherwise, the denominator is not very significant. So let me say that there's one gas plant in Uttaranchal, which we funded courageously a couple of months before. They were able to complete the plant. The gas supply came. They tied the PPA arrangement to the Uttaranchal government, and it's a perfect loan. Okay. The only thing we worry about is if the gas price goes up significantly, then would the problems arise again? And so we have advised the client to divest a part of his equity and get in money and rebalance the debt portfolio. So that's so far so good. As far as steel is concerned, mathematically I think we have an exposure of a little more than 6 to 7%. So again, the very nature of a portfolio is such that it is very well distributed.
What's the exposure to those 10 major indebted groups?
Well, we have them, but as I told you, we have never taken. There's never been any serious significant exposure. We are not the lead bank. We have not funded at the top co.
So, as a percentage, how much might that be?
I think whichever way you cut it, we don't have anything that would add to more than 7 to 8% of our balance sheet. It is the way it is.
Okay. Well, now let me come to the recoveries and upgrades. Do you think it can be significant in this quarter, or more importantly in FY17?
There would be upgrades for sure, but given the fact that we have a the debt provision is about, let's say, an average of 53%. Even if a small number of those customers move forward and get upgraded, the net effect could substantially help further in meeting the further provisioning requirement of the balance. So when we do a simulation on our portfolio and take a kind of let's say a stressed an economy that is going to be further stressed, and we put those numbers in, we don't see a flow of more than 1,500 crores happening from the rest of the 38,000 crore portfolio, because the money that the increase, the reversal of provision you get on what recovers is so large that it kind of funds the provision requirement on the other side.
Okay, that's good to hear. So can we say with some certainty that for Bank of Baroda or for well-run banks, 10% would be the maximum in terms of stress?
I would think so. Okay. I would think so, but I would also add we need to be watchful. And we have to be focused on collection, focused on management, especially of the SME portfolio, MMS, and the 1 to 5 crore segment, which I think is most vulnerable. The balance, I think, should be okay on the balance.
On that optimistic note, I'll take a break and then come back with a lot of questions on growth. We have put the bad period back. Let's discuss growth in a minute with Mr. Jayakumar of Bank of Baroda.